if we are live. It looks like we are live. Hello, everyone. Hello. I hope everyone can see me bright and clear. My name is Sharia Watson Moore, and we are here tonight for Women and Money. We have a panel of women who are very excited to share some information with you all tonight. And I'm just going to give everyone a few seconds, everyone on our panel, that is, a few seconds to go ahead and share our video from our Stewart Financial Services page onto our personal pages so that we can make sure everybody gets this information tonight. So while we do that, we do kindly ask that you do the same, especially if this is your second time joining us, because we did do this closer to Mother's Day earlier in the year. And by popular demand, we're going to do it again tonight. What we're going to do tonight is each lady on the panel will share 10 minutes of information, just going over the different services that we have here to offer to our community at Stewart Financial Services. So we are in partnership with American Classic Agency. And so the theme for tonight is Women and Money. However, that does not mean that men cannot join us. So if we have any men on the line, thank you so much for joining us as well. And I also want to thank everybody for taking their time out of their busy schedules, especially with school about to start. I know everybody's running around trying to find desks. I cannot find them, and I need about 6 of them. So we're busy, and being busy, it's hard to sometimes take time out to join a webinar. But I want to thank you personally, and the ladies on our panel also want to thank you for joining us. So again, each lady is going to take 10 minutes. We're going to start with Barbara Bukavich. She's going to start with us today and share some statistics on women. But I want to share some information about who Ms. Barb is today before we get started. And I hope that you had a chance to go ahead and share the video. But one moment, just trying to pull up Barb's information here. Okay, so Barb has a background in administrative healthcare and marketing, and she began her career in financial services in 1994. She started with American Classic Agency in 1997 as an agent and currently holds National Marketing Director with ACA, A3 Diamond Class, and she's also, a 3 Diamond Classic Club ring earner. She was the first woman to sit on American Classic Agency's boardroom. She also formed and developed ACA's flag, which is Female Agent Support Network. And she lives by 3 rules: never say never, expect the unexpected, and the last thing she lives by is the only thing constant in life is change. So I do want to go ahead and give Ms. Barb Bukavich the floor as she goes over some statistics for women. Barb, the floor is yours. Thank you, everyone.
Thank you so much, Sharia Watson Moore. It's been an awesome, awesome journey. And I'm so delighted and privileged to be on a group of just amazing, amazing women and strong professional females who really had the passion and desire and dedication and discipline to make changes in their lives and the lives of those around them. So I applaud each and every one of you for being on the line today and sharing this great information. No one's happy about this COVID and this lockdown and everything that's happening. But you know what? The good part is it's given us the opportunity to share all of this great information with everyone that maybe we normally would not have. So that's what I try to do. Look at the bright side of everything. So now I'm going to try to share my page here. And new share. And let's just hope that I can do this without that each screen will share. So can you see that now? Women in Planning for Wealth. One of the panelists can give me a thumbs up if you could see that.
Yes, Barb, we see.
Thank you so much. So is it filling up the screen, or is it small? It's not. Okay, slideshow. Beginning. How's that?
There you go. That's
yay.
perfect.
Okay, yay. Okay, so we are the Phenomenal Women of ACA, and we really believe that knowledge is power, but without knowledge or information, it's really meaningless unless you take action. And that's what we believe in at American Classic Agency in its totality. So I'm going to reference statistics, and thank you, ladies, for the privilege of allowing me to share this. This was a survey done by the Women's 2005 retirement survey findings sponsored by Heinz Philanthropy and their Women's Retirement Initiative. You can see that the source there, their website, where I got the information. But during this retirement initiative, this is what they found, and this is in 2005. So we are quite a distance into this, past this. And I'm going to tell you something and ask yourself this. Do you think these numbers have gotten better or worse since 2005? Most likely they've gotten worse. So, but in 2005, only 18% of women said that they knew a great deal about retirement planning, and lack of knowledge was most acute among minority women. And 41% of the women surveyed are worried they will live at or near poverty level in retirement. Also, 80% of all Americans are concerned they won't have enough money to live on at retirement. Of that, 71% African Americans and 59% of Hispanics are very, very concerned about that. Did you screen change now to my next? Okay.
It did, Barb, you're good.
Thank you. So, okay, 57% have little or no money left after paying bills to save for retirement, and 73% for minority women. 50% believe there is no such thing as retirement if that's defined as not having to work. And 1 out of 2 expect to take a full-time or part-time job after retiring to support themselves. 60% of minority women report they will have to continue to work. Now, let me ask you this question after hearing all of these statistics, and they're grim. They are very grim. And actually, I put myself in that category. I did a little retirement calculator, and I saw I was on a fast track to nowhere, to broke. And that's what got me into being a financial planner, into the life insurance business, into helping people manage their money, because I couldn't manage my money. I had no respect for it. But this business taught me that. So here's my question to you. Are you 100% sure you will have a secure retirement, or is there some doubt? 56% of millennial women born between 1981 and 1986. Now, this is huge, ladies and gentlemen out there. They defer their financial decisions to their husbands, compared to 54% of baby boomer women. Now, we would think that as we're progressing in life, right, that we would become more independent. I don't want to use the word feminist. I prefer to use strong and independent, but seems we're going backwards. So we've got to take a different approach. We need so many more reps in our business to carry the message, because it's getting lost. Our message is getting lost, and we have a big message, ladies and gentlemen. How about this? Women at age 80, 16% will be married. 1/6 will be married. Men at age 80, 80% will be married. How about that? What happened there? What's going on there? Well, women live longer than men. So just that fact alone, and we never know who's going to go. Our birth certificates don't have expiration dates on it, but the statistic is women live longer. And at age 80, if we're fortunate to live that long, which chances are we will, it's just going to be us, single. Widows experience a significant decline in income. Why is that? Because they lose one of the 2 Social Security benefits, right? In addition, if they were fortunate to have a pension, they may lose half the pension or the entire pension benefit. Women, we're not planning as individuals. We're planning as joints, as couples. And while that's important to do that, it's not what the statistic is showing us. So our daily living expenses stay about the same, even though our money's cut in half, basically. Everything stays the same. And on top of that, our medical expenses are literally insurmountable. Now, remember, these statistics were done 2005. And I know there's not been another one done since then. And these numbers are not as, the numbers are much higher. Debt, what we're not talking about here also is the left behind debt accumulated from a lifetime of spending. Elderly women are twice as likely to live in poverty than men, because women earn less and have less to save. Women earn less. Why do we earn less? We have caregiving responsibilities, making more likely to leave our jobs, work part-time, and forfeit pension or 401k contributions. Okay, important. Yesterday, I was talking to a young girl. She said, oh, my boyfriend said I could put all my money that I make here at my job, I could spend it here. I said, are you contributing to your 401k? She said, he's doing that. Okay. So I had to count to 50. And she, right? I said, please no. So I was very calmly said to her, you need to continue to contribute to your retirement plan, when, even though he may be doing that, and that's great, you still need your own. It gives us value, ladies and gentlemen. It gives us worth. That's just the truth. The average American household debt is $137,063. That's of USA Today, November 2017. Average American household debt. And once that person passes away in a couple, in a marriage, or in a couple of relationship, that money doesn't just disappear. Someone's responsible for that. Importance of your having your own retirement account, because qualified money can only be transferred to another person upon death or divorce. That money is subject to taxes, fees, and penalties, resulting in up to a 50% loss if that has to be liquidated before age 59 and a half. And also lifetime income streams can be jeopardized. Let me also add that if a stay-at-home mom or dad, if someone were to be hired to do all the things responsible for that stay-at-home parent, that cost would be over $250,000 a year. That's what it would cost to run that household, everything that a stay-at-home parent would do. So I don't believe that there's enough value put on that stay-at-home parent's job. And I would love to see the day where a stay-at-home parent would have equal credibility on a resume, on a job resume, as to a CEO of a company. To me, that would be justified. So planning for life events, here's what happens. There's a disability. 45% of 40-year-olds and 80% of 20-year-olds will experience a disability during their working years that will last 90 days or more. That's minimum. And we see people, young people in nursing homes, not old people all the time. There's young people in there. And Blue Cross Blue Shield also did a survey, and they're saying, it's not a survey, they're experiencing their utilization, and they're diagnosing younger early onset Alzheimer's. Blue Cross and Blue Shield. So they're finding claims that there's significant increase in those numbers. Life event number 2, retirement. 50% of Americans have saved less than $50,000 towards retirement, and 15% have saved nothing. I think those numbers are way off, but that's what the numbers are. I think the numbers are a lot higher than that. Life event number 3, illness. What if you become chronically or critically ill? Heart attack, stroke, cancer. At age 65, odds are 1 in 2, you're going to require some kind of nursing home service for at least 2.5 years. Life event number 4, an untimely death. 60% of women don't own personal life insurance. 45% of widows said their spouse did not have enough life insurance or none at all. And how many people believe that when they had to make a claim for life insurance, it wasn't enough? So even the ones that have life insurance, it's never enough. So it's important to have the new kind of life insurance, the kind that you don't have to die to use. And we'll go over that and some more in our wonderful women panel of experts. Here's the retirement calculator that changed my life. How many years have you been working? What's been your average income over that time period? You multiply A times B, and you come out with your total working life so far, what you have made in your life. And the big question is, how much of that have you saved? How much of it can you put your hands on today? And when I did this in 1990, my answer was zero. I had nothing, even though I was working for a very long time and I made hundreds of thousands of dollars. So I made changes in my life, and a career in financial services significantly helped me make the right decisions. You can have your golden years budgeting your money, and we'll go through this some more. Our expert panel, we're going to go through it all. But the most important thing is to pay yourself first, 10% of your income. If you can't pay for it and pay your credit card off every month, then you don't buy it. Get control of your income and your finances. So let me turn it back now for our next segment. Thank you so much. There will be Q&A later on, I believe. So I'll be happy to take any questions. But back to you, Ms. Sharia Watson-Moore.
Thank you so much, Barb, for that valuable information. I really appreciate that. If you could just unshare your screen for me at this point. And Barb will be joining us again later on with some more valuable information in regards to the opportunity here at American Classic Agency and Stewart Financial Services. But over the next 10 minutes, what I'll be doing is sharing some information in regards to budgeting. And I'm going to go ahead and get right into it. For those of you who do not already know, my name is Sharia Watson-Moore, and I've been with Stewart Financial Services since 2014. And it was one of the best decisions I've ever made. We'll talk about that later on when we go over the opportunity here. But we just all have to face the reality that budgeting is imperative when it comes to creating wealth, right? So with budgeting, we have to create a physical budget, something that we can reference every day. That means that your budget should be written down, right? And most of us, we skip it. This is something that a lot of us tend to do. We tend to think that it's not necessary to write down our budget. And what we do here at Stewart Financial Services is we help people find, save, and accumulate money. And one of the ways in which we do that is by creating our physical budget. Now, you may have heard me say this before, but when you don't write down your goals, whether they're personal goals, career goals, or financial goals, it's like constantly juggling and never putting down the balls, right? So can you imagine how exhausting that could be? So once you write down your physical goals, not only do you start to feel lighter, you start to become happier, and you start to walk taller. And with that being said, what I would like to do is share with you a story. And I'm just going to go ahead and pull that up on my screen right now. One moment. Okay, one more second. Should have this up. Okay, the story is called The Pleasure of Walking Tall. And I'm just going to make sure that you can see it from the beginning. All right, so let's see what we have here. Okay, can you see the story here, The Pleasure of Walking Tall? All right, you don't see it? Okay, hold on 1 second. 1 second. Sorry about that. Thank you for your patience. One moment. Okay, so this should bring it up now. So if you could just let me know if you can see The Pleasure of Walking Tall at this point. And again, thank you so much for your patience with that. Thank you. What I would like to do is read this story along with you all. I will take just a few minutes to go through it. I actually, and a lot of us on this panel, we read this at least once a week to keep ourselves motivated. But it says, your savings, believe it or not, affects the way you stand, the way you walk, the tone of your voice, In short, your physical well-being and self-confidence. A person without savings is always running. They must take the first job offered, or nearly so. They sit nervously on life's chairs because any small emergency throws them into the hands of others. Without savings, a person must be too grateful. Gratitude is a fine thing in its place, but a constant state of gratitude is a horrible place in which to live. A person with savings can walk tall. They can appraise opportunities in a relaxed way. They have time for because they have time for judicious estimates and not be rushed by economic necessity. A person with savings can afford to resign from their job if their principles so dictate. And for this reason, they'll never need to do so. A person who can afford to quit is much more useful to their company and therefore more promotable. They can afford to give the company the benefits of their most candid judgments. A person always concerned with necessities such as food and rent can't afford to think in long-range career terms. They must dart to the most immediate opportunity for ready cash. A person with savings can afford the wonderful privilege of being generous in family or neighborhood emergencies. They can take a level stare in the eyes of any person, friend, stranger, or enemy. It shapes their personality and their character. The ability to save has nothing to do with the size of income. Many high-income people who spend it all are on a treadmill darting through life like a minnow. The dean of American banker J.P. Morgan once advised a young broker, take waste out of your spending, you'll drive haste out of your life. I want to read that one more time. Take waste out of your spending and you'll drive the haste out of your life. So if you do not need money for college, a home, or retirement, then save for self-confidence. The state of your saving does have a lot to do with how tall you walk. And so again, I mean, I don't know if you can feel how powerful that is, but if you read that, just like you do affirmations, you know, that does keep you motivated, because creating healthy financial habits like budgeting, it is tough to do when you first start out because it takes discipline, but in the long terms, it's very, very much so worth it, right? And so with that, hold on one second. Crystal, later on when she comes up, she's going to talk to us in a little bit more detail about compound interest. But this graph here just shows you if someone's contributing $50 per month, paying themselves first, it shows you the power of compound interest. Now this 4%, 8%, and 12% interest, I mean, these numbers represent interest that can accumulate on your savings. And after 5 years of saving $50 per month, you have a total of $3,000. After 40 years, you see you have $24,000. And with compound interest, 12% on $50 a month after 40 years is $489,000. So that just shows you the power and impact of compound interest. But again, Crystal will go over that in a little bit more detail when she comes up. The last thing I want to share with you is, so why should we plan for our future? Why should we? And it says right here, if you do not adapt a plan for your future, you will stay. I'm sorry, if you do not adapt a plan for the future and stay with it, the odds will be against you, okay? And here's the numbers. 56% of Americans, ladies and gentlemen, by the time they reach the age of 65, they'll fall into, people, by the time they reach the age of 65, will fall into one of four categories. And 56% of them, believe it or not, will depend on the government, charity, or someone else to take care of them. That's just how it's playing out. And 25%, they die. They don't even make it to see the age of 65. Then we have 11% who are, unfortunately, they're still working. Oftentimes, these are the people that we see at Walgreens. They're usually the greeter at the door. Oftentimes, those people are not there because they want to be there or they're just trying to stay busy. They're there because it's a necessity. Somewhere down the line, it just fell to plan, okay? See, we don't plan to fail, we just fail to plan. And then we do have 8% who do retire financially independent. But if you were to actually Google this study here now, you will see that the numbers are actually off. Less people are retiring financially independent, and more people than 56% are depending on the government. And so what that tells me, or what that means to me, is that in one of the world's most richest countries, by the time people reach the age of 65, they're either dead or they're broke. And that's just because, again, we're just not planning. And so Barb, she went ahead and shared this information here with you. What we can see from budgeting is that not only does budgeting keep us from juggling our funds, but it also builds our character, and it also helps us to accumulate wealth with the use of compound interest. So once we understand that and understand the power and purpose of why it's important to physically write down our goals, then at that point, you know, we're in a position to be able to create real wealth for the next generation. And so that's what I have for you all tonight. Again, we're keeping it very short. So with that being said, I would like to bring up Crystal at this point. Crystal's going to share with us some information about tax-free strategies, because if we're going to be creating real wealth, we do have to keep a certain somebody out of our pockets. And I'm sure Crystal will let us know who that certain somebody is. Crystal, the floor is yours.
Thank you so much. It's our favorite uncle. And I'll we'll get on that in a little bit. Give me 1 second. Let me share the screen here. Okay. Can you ladies see here my screen? Thumbs up. Awesome. I'm going to put it in presentation mode. Awesome. Okay. You can see? Good stuff. Good stuff. Thank you. Again, my name is Crystal Hollingsworth, and I'm humbled to be able to share with you all our smart retirement money order and our tax retirement session. Guys, people are right now afraid. What's going on in our world, our nation, the economy, we're feeling out of control. People are anxious, not knowing whether or not they're going to have income tomorrow. And so I believe that the things that we can control, because we're feeling so out of control right now, the things we can control, we must. And so there are a variety of ways that a person can actually prepare for retirement. But one of the ways that I actually like to focus on is a way that a person can actually prepare without the impact of future taxation. We literally have no idea what's going on in the future. And so again, we want to be able to take some of our power back, okay? And, you know, put our money somewhere where we don't have to worry about whether or not, you know, the money's going to be eaten up in taxes. And so I like to refer to our smart retirement money order, okay? And this is a smart way for people to save and invest your money, but it's in the order that's most beneficial to you, the retiree, or the person that's actually saving. So first source of money, we have free money, all right? And that makes me smile. And as serious as I tried to be with this presentation, because we are just in a very uncertain times with free money, we have tax-free money, and then we have tax-deferred money, and then there's taxable money. And some sources of free money is inherited money. Maybe you're, you know, you have a family member, rich aunt or uncle that has money that upon their death that you're going to be the heir to, or either the matching money for your TSP or your 401k, that contribution that your employee is actually matching, that's a source of free money. Or even, let's say, the lottery. My point is, it doesn't mean that you're not going to pay any taxes on this money. It just means that you didn't do anything to earn it. So the best source of money based on the smart retirement money order is free money. Our second source of money is tax-free money. Now, tax-free money, I already said that, you know, most people have no idea that you can actually accumulate or save for your retirement on a tax-free basis, but it's something that you can do. And so a Roth IRA is a tremendous government program. It's still in the stock market, but the only thing about the Roth IRA is you're penalized if you make too much money. And so here in the DC, Maryland, Virginia area, it's a high income district. And so the incomes, you know, most people can't even contribute to a Roth IRA. Get back with the person that actually invited you on the presentation to get the details of that. But, and let's just say if you are a part, you know, you're able to contribute to a Roth IRA, if you actually start to do what you're supposed to do, which is, you know, get promotions, then you can be phased out of the Roth IRA. And so again, it's almost as if you are penalized for making too much money and doing what you're supposed to do. But then there's life insurance cash value. And I do want to park here just for a little bit, because life insurance is, I would venture to say that it's one of the most misunderstood financial tools on the market. But if used properly with the proper use of loans and withdrawals, you can accumulate a tremendous account of tax-free money with cash value life insurance. It is a wealth building tool. Banks and corporations buy it by the boatloads. BOLI, bank-owned life insurance. COLI, you want to write this down, corporate-owned life insurance. Again, you know, the wealthy understand the importance of the tax-free savings inside of cash value life insurance. And so it's probably one of the most not just misunderstood financial tools in the market, but it's the #1 way to actually save in a way that you don't have to have the impact of future taxation. The average person just says, listen, life insurance isn't for me. It's for the people I leave behind. Let me just get the cheapest kind I can get. No, you have to understand the power and the purpose and the tax advantages so it can work for you. Again, we want to take our power back. We want to take our power back. And so I get actually really excited when I talk about cash value life insurance, because again, this is one of the things that's really good for us. It's a tax shelter for the wealthy. If it's good for them, it's good for us, okay? So again, get back with the person that invited you on the presentation so they can get you some more information. Okay, next source of money, it's our tax deferred money. Annuities, amazing products. If you've worked on your job for, 20, 30, 40 years and you have a lump sum of money that you actually want to roll over because you want to get a safe accumulation of funds and eliminate the risk, you roll that money over to make sure that it pays you that income for the rest of your life. And so annuities are great products for lump sums, all right? And then you have your tax qualified plans. We call this the alphabet soup. Your 401k, your TSP, 403Bs, 457, your IRAs. Now, in these plans, you're actually oftentimes building a tax bill for yourself because you're paying taxes at the end. And so you're taking, in essence, your deduction right up front. And what happens is, again, we don't know what's going on in the future. And this is where the sleeping giant lies. This is where a lot of people get hurt. And so the government preaches, not anti-government, we love the government, but you want to make sure that, just putting that on out there, this is a government-friendly call, but you want to make sure that you're just not listening to mainstream information, because oftentimes that mainstream information does not benefit you. It benefits the source that's actually putting that information out there. And so again, you want to make sure that get back with the person. I can't stress this enough, because I'll say your mind is like a parachute, doesn't work unless it's open. Oftentimes people are afraid to, just have an open mind. But tax deferred money, that's where most people put their dollars. And then taxable money. Here's a good thing about taxable money, though it's on the last on the list: wages, capital gains, interest, Social Security. You know what? You have a job to be taxed. How many people right now, the unemployment is crazy, would love to have a job just to have that taxable money? Okay, but here's what's going on. Everybody knows that, free money is the best source, right? You find money in your jeans, you're happy, it's the best source. But we're skipping a vital step, which is that tax-free money. So we're going from free money right to tax deferred money, and that's not what we want to do. So this smart, we're all smart on this line. Smart Retirement Money Order says free money, tax-free money, then tax deferred. Let's go ahead and take advantage of that free money. All right. So now let's talk a little bit about life insurance. All right. There's so many different kind of policies out here, and I don't care if it's term, if it's permanent, if it's variable, if it's whole life, if it's renewable, whatever the name is, it's going to fall into one or two categories. And so if we look at this as real estate, term, you're renting the coverage. Permanent, you're actually owning the coverage. All right. So let's go into it a little. Term, it's a lower cost initially. So I'll qualify that by saying initially, because once your term is over, then of course that cost goes up. So if you go into an apartment and you're there for a year, whatever your lease is, once your lease is up, then of course your rent is adjusted. Same thing with your term, whether it's 10, 15, 20 years, even 30-year terms. Once your term is over, then there's going to be an adjustment on your premium. There's no equity, or as we call it, cash value that builds up in it. So like my parents stayed in an apartment way too long, forever. And when they left, honestly, it's like 30 years, they just said goodbye. There was nothing in it for them. And they just handed the keys over. So in term insurance, if you have a 20-year, 30-year, and you outlive it, which most likely you will, then you're just older and you have to get more insurance. All right. And then coverage ends at some point, and a lot of people get fooled because it says, oh, it's going to go until age 85 or 95. No, it says renewable. Look at that fine print. And it says renewable. And so you want to make sure that, again, if you get term, that you're getting it, you know why you're getting it, and it's purchased to meet temporary needs. All right. Ladies, I don't know how I'm doing on my time, but I'm getting through it. So, so permanent. So it's a higher cost initially. Okay. So it's higher. So here's what happens with it. You're in it though. There's no adjustment in premiums. You are in it, whatever age you lock in at, you know that that's going to be it forever. So it's like your mortgage. If you didn't get a, stated loan or balloon. So if you get a fixed, you already know for the rest of your life what your mortgage is going to be. Same thing with your permanent coverage. As long as you get it and you lock it into that age, that's going to be your premium forever. And then the cost again is level. And there's equity. We like to call it cash value. All right. And it's tax free. So it grows and it grows and it grows. And then there's that tax free cash value that, again, the wealthy, banks, corporations know about. All right. So if it's a goodie for them, it's a goodie for us. And then coverage never ends, providing you pay your premium. Okay, so you have to pay your premium, but coverage actually, it just never ends. And then it's owned to meet permanent goals. And if you felt my energy on the permanent side, that maybe I am a little more, I like permanent a little more. I do, because there's so many more things that you can actually do with it. But I've never heard of a person passing away and their family members say, well, is it term or permanent? They don't care, it all pays out. But we want to make sure that we understand the power of the purpose and the tax advantages of permanent coverage. And just to go into it just a little more in detail, how universal life insurance works, and this lights me up. This really does, because this gives you a sneak peek into how these products work. So this is you, okay? And you are paying into your life insurance program, all right? We have a comprehensive program. And so this is your UL, Universal Life Insurance Program. And so do you see this dollar sign right here with the little gray box? So let's just call this $100,000. So this is what your death benefit is. So you are paying your premium every month into your death benefit. But you notice this box, this dotted box right here? And it says maximum that the IRS will actually allow. I wish we could just have it open. Why do you even think the IRS has any interest in what you're doing with your life insurance? This is your life insurance. It's for your family. You're building a legacy. Why do you think they're involved in this? You know why? Because once you put your money into this policy, it's bulletproof, asset protected, protected from creditors, protected from lawsuits, protected from probate, and it is completely tax-free. And so the government said, no, no, no. Back in the 80s, people were just pumping these things with cash and, walking right past Mr. Taxman. So they have put some laws in place to control that. But here's what happens. Let me move my box down a little. It pays out tax-free cash value. Again, I can't stress enough, tax-free, because I've had people join these programs and they go, well, if I take a loan against it, what do I have to pay? How much in taxes? No, listen. It's tax-free, totally tax-free. And then you can actually structure this where it pays you in income that you can't outlive. That's almost unheard of, but tax-free lifetime income. And then upon your death, it pays to your heirs, tax-free death benefit. When I learned this, I was just through the roof, through the moon. This is what made me say, you know what? I need to take a position in this company. And we're all, when I say position, we're all independent contractors. So, we work for ourselves, but I knew that there were other individuals that needed to know this information. And I almost felt like it was selfish because once my eyes were opened, I felt that in my community, Barb gave the statistics that I needed to share this. I needed to share this, with my community. And so that's my segment. Make sure that we're going to have a Q&A at the end, but this was just a snapshot, an abbreviated version of tax-free retirement. And with that, Ms. Sharia Watson Moore, I will turn it back over to you.
Thank you so much, Crystal. Thank you. And I want to apologize. I did not properly introduce Crystal to everyone. She did speak about her experience, but she has been in the business with Stewart Financial Services since 2018. So she was serious when she said she had to come over and join us, right? She's also on the Women Wellness and Wealth Conference Committee. And she's an awesome leader. As you can tell, she's an awesome trainer. And in addition, if you haven't heard, she was recently awarded for having the largest single premium case. So kudos to Crystal. And with that being said, I do want to now introduce to you Kim Washington. She's been with us since 2016. She comes to us as a federal employee, and she's also a major contributor to the Stewart Financial Services team. And again, she's going to cover annuities today. Kim, the floor is yours.
Thank you so much, Ms. Sharia Watson Moore. Crystal, can I have you unshare your screen, please? Thank you. But while she's doing that, oh, perfect. I'm so excited. Women in Money. This is a very, very timely subject, and you guys are in for a real treat. All of this information we have coming to you tonight. So I'll be talking to you today about annuities. But before I get into that, I want to generally talk about how does investing work. So if you're in the market, it goes up and down, up and down, up and down, more down lately, unfortunately. But you want to be asking yourselves, do you have what's called a market risk prevention plan? So what do many advisors say? They'll say, well, stay in the market, wait it out, hold tight. Well, it's only a paper loss. The market will eventually come back. But the real investment truth is that the average 401k management fee is about 2.25%. So while this may not seem like a lot, for a $100,000 account, this fee costs the investor about $100K over a 20-year period. $100K is a lot of money. So what would you prefer to base your retirement on? Would it be certainty, security, guarantees, or speculation, volatility, or uncertainty? So here's a critical question. What amount of risk should you have in retirement? If you're like me, I don't want to risk anything. I don't like losing money. But, there's a difference between a conservative, moderate, or aggressive investor. So you need to determine what your risk tolerance would be. And what is your time horizon for retirement? Are you 20 years out, 30 years out? And does that match your significant other's answers? So here's a solution to protecting your nest eggs while growing more nest eggs. It's the power of fixed indexing. For example, you have some markets, S&P 500, NASDAQ, the Dow, the Russell. So here's a task. In the market, you'll have some ups, but you'll also have some downs. And the task here is to implement what's called a safety net strategy. So you want to keep that lovely golden egg from sliding down and losing money, so to speak. So this is the effect of what's called the safety net strategy when you're saving for retirement. You can participate in the gains, but you can participate in some of the gains, but absolutely none of the losses. So you see here, every place where the market took a dip, your golden egg stayed at the same level. And when the market started gaining again, your golden egg started gaining again. So that is the effect of the safety net. So the earnings are pretty reasonable. And furthermore, the strategy has no fees, no administration charges. And as your money grows, There are no federal income taxes, no state income taxes, and no Social Security taxes. You're being shielded from taxation out the wazoo as your money continues to grow. So the choice is yours here. Do you want that downside protection of the safety net strategy, or do you want to hang out on the ledge with no downside protection, ready to lose it all at any moment? So this is a very boiled down version of what a retirement account looks like. So let's talk about these 3 lines. And at the end of this, we want to eliminate one of the lines. So let's say the black line is, you had $100,000 in your account and it pretty much stayed the same. It didn't go up, it didn't go down. Now let's talk about this red line. Your account is losing money. And then the green line, your account is consistently gaining money. So if you had to eliminate one of these lines from your retirement portfolio, what would it be? Well, of course, the red line. Nobody wants to lose any money when they're trying to save for retirement. So this is an actual fixed index annuity versus the S&P 500. So I'm going to go through this. There's a little bit of a lag time, so I'm going to try to slow down my talking here. So bear with me, guys. So let's take a look at this green line. No, first, actually, let's take a look at the red line. This is the S&P 500. So you'll see here from 1998 up until about 2000, the market was doing pretty good. So if you had 100,000 in 1998, it grew to about 136,000 in 2000. But then what happened? The market took a hit, and that account ended up going down to about 78,000 in 2002. So let's take a look at this green line. And the green line represents the fixed index annuity. So you'll see here in the years where the market took a dip, the account value just stayed the same. So in the year 2000, the account value was about $125,000. And then once the market started gaining again, if you're looking at that red line, the account started gaining again. So never losing money, implementing that safety net strategy we talked about on the other slide. So you can see here, not losing any money or implementing that safety net strategy makes all the difference. So you'll see here that the green line grew to about 223,000, while the market did about 206,000. So just by not losing any money, you can come out better when saving for retirement. So there are 3 phases of retirement planning. You have what's called the accumulation phase, the preservation phase, and the distribution phase, which is a fun part where you get to start taking out some of that income that you've been saving over the last 20, 30 years. But there are some real concerns: outliving one's resources. And how do you actually protect yourself from outliving those resources? So here's the solution to that. You need to utilize a strategy that can provide you with income which you cannot outlive, is immune to the market volatility of ups and downs, and can provide income for surviving spouses. So what is an annuity? An annuity is a contract between an individual and a life insurance company. So that individual provides the life insurance company with periodic premiums over time or one lump sum payment. The life insurance company then guarantees that individual periodic payments over a specific amount of time or the entire life of the individual. So you're never running out of money. And annuities are typically suitable for people needing pension replacement, people wanting guaranteed income, people that desire legacy preservation, and people with a low risk tolerance, and people seeking a safe alternative to the market. So with the new kinds of fixed index annuities, they can provide you with some immediate cash bonuses, stock market gains, but never any of the losses, and no fees ever. Guaranteed lifetime income riders, which actually will lock in your payout percentage. Guaranteed withdrawal payments without annuitization, and an enhanced income for nursing care, which will add about 50 to 100% more income. So I'm going to stop it right there and turn it back over to you, Sharia. There will be an opportunity for you all to ask questions at the conclusion of this presentation.
Thank you so much, everyone. That was Kim Washington. And as promised, we have 10 minutes each. So I'm going to quickly introduce Ms. Monique Beidelman. She's been with us for over 17 years. She's a college graduate from Howard University. She has a passion for speaking to women's groups, churches, and even civic organizations. She's going to cover with us today debt elimination. So if you want to get out of debt, this is the time when you want to definitely grab your pen and paper and tune in, because Ms. Monique is going to cover how you can get out of debt. Monique, the floor is yours.
Thank you so much, Sharia. Can you hear me okay?
We can hear you loud and clear, Monique. You're good.
Fantastic. Thank you so much for the introduction. I am going to speak with you all just a little bit about getting out of debt through your family bank concept. So you all, this is not a new concept, but you've got to understand how banks work. So I'm going to ask a lot of rhetorical questions this evening, because I know you all cannot answer back to me. But these are questions that I want you guys to ask yourself. Question number one, if I could show you how to become your own bank and become the saver, become the borrower, and the bank, would you want to hear more about it? That's question number one. I always ask, is there anyone out there that wants to be debt-free without having to put out any more money, right? Question number two, is there anyone out there that wants to build wealth? I know we do, and a lot of times we just don't know how to do it. So the question is, do you want to build wealth? Is there anyone out there that wants to be debt-free and also build wealth at the same exact time? Well, I truly believe that your family bank concept is the answer. So the concept is about really becoming your own bank, right? Banks loan depositors monies at a higher interest rate than what the savers are getting in their accounts. And the difference between those two rates is their profit, which is called the spread. So banks turn over money at least 7 times. So the key with this Your Family Bank concept really is using every dollar twice. I'm gonna say that again. Using every dollar twice to pay off debt and also to build wealth. So let's get into it real quick. I'm gonna be obedient because I know that we have just about 10 minutes. I'm gonna share my screen. Bear with me here 1 second, and I'm gonna pull it up. Okay. All right, give me thumbs up, you guys, if you can see my screen. Fantastic, thank you so much. All right, you all, I have some additional questions. I said I'm gonna give you guys a lot of rhetorical questions. I know you can't answer, but listen, what if we could teach you how to reduce the volume of interest that you are paying to lenders? Would that be a good thing? What if you could teach you how to get out of debt in 9 years or less, you all? And I'm gonna add including your mortgage. Would that be a good thing? What if we could teach you how to improve your cash flow? What if we could teach you how to decrease taxes? And what if we could teach you how to save for college and retire with a tax-favored income? Would these be good things if we could show you how to do this? I think it would be. So let's take a look at a typical American family. Mark and Joyce, they are actually clients of the Your Family Bank concept. So let's take a look at their financial worksheet. So Mark and Joyce, they're age 37 and age 35. Okay, they have a monthly income of about $7,000 a month. All right, they have 3 children, 3, 4, and 8. They have a retirement savings that's less than $100,000. Their desired monthly retirement income is about $5,000 a month. So when we sat down and we talked to Mark and Joyce, they knew that they needed to understand some basic financial concepts. So the main areas of interest for them were they wanted to increase their retirement income, right? They wanted to reduce their debt. They wanted to get their spending under control. Who can attest to that? Let's get our spending under control, right? Who wants to increase their savings? Who wants to college plan for their children? And guess what? They also needed some life insurance as well. So important. So if we continue on. All right, so their savings and investments, they have an emergency fund set up. They have about $6,000 in a Bank of America account, all right? And then they have for their 401k retirement plan, they have about $36,500 in their retirement plan. So here are their debts, you guys. Who can relate to this? Who can relate to this? When I look at this, I said, that was me, right? You have a Visa card, right? $460 balance at a 12% interest rate. You have some medical and dental bills. You have a balance of over $2,400. You have a credit card, whatever that credit card may be, the interest rate is going to be 16% plus. Okay, you have over a $4,200 balance on that. You have a furniture card, 18%, over $5,900 balance on that. You have a car loan, right? An interest rate of 8%, over $13,000 for that balance. And then you have your mortgage, which is your biggest debt, at an interest rate of 6.5%, with a balance of $153,781. So your total debt is an average interest rate of about 10%, right? And your balance is over $180,000. Your monthly payments for all those debts is $2,177. So let's take a look at their debt in detail, right? So when we ask Mark and Joyce, what's your debt? Right? They say, oh, my debt is $180,000. But guess what? We all know that that's not their debt, right? Because what they're going to pay over 30 years is close to $200,000 in interest. It's about interest. It's about taxes. Crystal talked a little bit about this. So their real debt is not $180,000, ladies and gentlemen. Their real debt is over $380,000, right? So when we told them that, they were like, my goodness, what can I do? So let's talk about their retirement plan. They have $36,500. Remember, that was in their 401k. That's their current retirement savings. They're making $300 a month contributions. Their money is gaining a 5% annual interest rate, and they're in a 25% income tax bracket. So listen, you all, at the end of 30 years, before taxes, their retirement monies to them would be over $408,000. After taxes, listen, you all, remember, Crystal just talked about taxes, right? Uncle Sam, we got to get rid of Uncle Sam. After taxes, their money will be over $306,000, $668. So let's take a look at what we were able to do with Mark and Joyce through the Your Family Bank plan. Here's what we were able to accomplish. And this is astonishing. We freed them from lenders in 7.8 years, you all. 7.8 years, all of their debt was completely paid off. We saved them $122,739 in interest. $122,739 in interest. We freed up that $2,177 per month, right? Because they have no debt. So that $2,177 is now freed up for them to put into their retirement fund if they choose to do so. And guess what? Savings in 30 years is going to be over $1 million. What? Let's get excited about that. So the current plan, again, let's take a look. $306,000 after taxes for retirement. That's the current plan. But your family bank plan, over $1 million in tax-free, tax-favored retirement. You can't beat that, you guys. So let's talk about what's the cost not to do the Your Family Bank plan, right? So we have over $1 million. Let me be specific. $1,004,387 in retirement is what we're looking at in the Your Family Bank plan. We have saved them $122,739 in interest saved, right? We talked about interest, we talked about taxes. So the total of $820,458. That's the cost not to do the Your Family Bank plan. You've got to ask yourself, again, a rhetorical question. What is it going to cost me not to do the Your Family Bank plan? Over $820,000. So you all, I'm going to end with this. The Your Family Bank concept, again, has been around for years, right? You may not know these individual faces, but you certainly know their names, all right? So if we take a look at what was done, Walt Disney from Disney World, right? He was turned down by traditional financing, and he used a loan from his banking concept to finance Walt Disney World, you guys. Walt Disney World, all right? Doris Christopher, she's the Pampered Chef. Remember, she actually sold her business to Warren Buffett for millions of dollars. But Doris Christopher had a dream, right? She borrowed $3,000 from her banking concept to start her company. She's a millionaire by selling her business to Warren Buffett. James C. Penney, you all, that's J.C. Penney, right? Depression. His banking concept allowed the company to continue operations during the Depression, right? And then we have Ray Kroc with McDonald's. He continued to keep all his stores open in regards to hard times by using loans against his Your Family Bank concept. So I can't stress the power of this concept. We're not refinancing debt. We're not consolidating debt. We are eliminating debt. And you do that by minimizing interest, and you do that by minimizing taxes. There are programs out there right now, you guys, where they help you get out of debt, right? But then you have no wealth buildup. It's about getting out of debt and also building up wealth, right? Because what happens once you get out of debt, a lot of times, then you have no cash. So then what happens is you start to accumulate more debt. Because what do? We start charging the cards again. We take out loans, we do all these things to get us back into debt. So it's very important to understand that it's simultaneous. You have to get out of debt while building wealth. The key with this program is we're not saying that you will not accumulate more debt throughout the years, because let's just be real, we probably will. We probably will, but let's plan for it. And when it does happen, you have a bank set up, your own bank that's set up where you can take money from it to purchase things, as opposed to a commercial bank or lender. So I truly believe that there is a light at the end of the tunnel. You could be out of debt quicker than you could ever imagine without having to use any new money. Any new money, that's key. So I do truly hope that this gives some folks hope. It changed me and my family's lives. And I truly believe it could if you keep an open mind, it could change your life as well. So I'm done. I am going to turn it back over to Miss Barbara Vocavage, and she's going to give us some tips. This business has been a blessing for a lot of us in regards to taking on additional income and being able to help and serve the community. So I want to turn it back over to Barb to talk a little bit about the opportunity before we close it out.
Thank you
Barb,
so
it's
much.
you.
Okay, can you hear me?
I can.
Okay, thank you so much, Monique. That was Ms. Beidelman. That was very insightful information. We are going to have a Q&A section, right? We're going to have a question and answer. Okay,
Yes,
so
we
I'll
are.
just take a few minutes here, and I think it's really imperative. Why are we doing this, right? Why are we on Facebook Live? Why are we doing this as a group? Because I know I'm on my Facebook Live. I have a lot of people watching, and all this information that we've shared tonight is one of the best kept secret in the USA. It's not something that we hear about on a daily basis. So it's my passion, and I know all the ladies on the line, our panel tonight, it was their passion as well, to share their knowledge, their vast knowledge of expertise and wisdom with everyone out there in the internet, on Facebook, who cares to listen to us. But what we have our hands on, and those of us on the panel know, it's the best kept secret in the USA. The question is why? Why does everyone all hooping it up about the stock market and not everybody's hooping it up about annuities? Not everybody's hooping it up about life insurance. You got to ask yourself why. Okay, and you could come to your own conclusions. I know we all have. And I'm not saying there's anything wrong with the stock market. I just don't like losing money. Warren Buffett's 3 rules of money. What's the first rule? Don't lose any money. What's the second rule? Don't lose any money. And the third rule is go back to rule number 1 and rule number 2. And one of the ladies said it tonight. I believe it was Crystal, and talking about the stock market and when your account goes down, and all the excuses were given about, no, you didn't really lose any money, only if you sell, buy more. My personal opinion is that needs to be illegal, because it's all lies, basically. And it just keeps the truth from being told. And we are truth tellers. And what we're trying to do, our mission, our passion, is to change the lives of middle Americans. And this is one of the reasons why yes, we want to know, we want clients, of course we want clients, but we believe an educated client is what we want. We're all about educating the masses, bringing the information out there so middle Americans can make better informed decisions and not just have certain things shoved down their throat because it's the only option they have, right? So this is why we're bringing this to you tonight. In addition, we need more people, more committed, dedicated agents, representatives in our business. So maybe you were thinking about this as we were going along with the with our Zoom here, but if it, and I like to say this, if it had at all hit a chord with you, if you felt any kind of a desire to believe in what we're doing, help us share our message, and get paid what you're really worth, create a better quality of life for yourself, build true financial freedom for you and for your family, have total control of your time. Okay, this is, if you said yes to any of those questions and you tuned in tonight and you want more information, we are delighted to share that with you. And that's going to happen. Can you see that on the screen now? The ACA.com, ladies, thumbs up. Okay, this is, before we get into our question and answer segment, tomorrow evening, we're going to do a Zoom as well. There's a Zoom call tomorrow about the opportunity with the American Classic Agency. That's Tuesday, September 1st at 7 p.m. If you're interested in hearing it, it's a 45-minute segment. More information. We'll get into all the nitty-gritty of it, and it'll be the best, I promise you, the best 45 minutes that you have ever spent in your life, in addition to what you just heard tonight, which is invaluable information. So inbox who's ever show you're watching tonight, your watch party. You can also go to aclassic.com and hit join us. Even if you don't have a license or you're not ready yet, you can just put your information there. But get with the person that invited you on the call or whose page you're on tonight, and just send them an inbox. Or you can put a comment on the stream here. Send me the info. That's it. Send me the info, and we will send you the invitation to the call tomorrow night. But we would be delighted to have you and work with you and change your life as you're changing the lives of those around you. So with that, I'm going to turn the call back over to Ms. Sharia Watson-Moore to bring us into a muchly anticipated question and answer segment.
Thank you so much, Barb. Thank you. I am excited after hearing all the information. And again, I just want everybody to remember, don't be so consumed with whether or not you got all the information in such a short period of time. If you have questions that we don't answer tonight, you can reach out to any of us on this panel, and we will be happy to sit down with you one-on-one and go over your own personal finances. But in the meantime, if you have a question, please feel free to go ahead and leave that question in the comment area right now on Facebook Live. If there are no questions, then we're gonna go ahead and close out for tonight. It is about 8:15, so I do appreciate everyone's patience with us. We get excited, and sometimes we just don't want to leave out anything. So if we all snip that a couple of minutes, please do forgive us. I don't see any questions, ladies. I don't see any questions. So I cannot thank you all enough for being here with us. And we will keep you all posted for when we do something like this again. And as Bart mentioned, tomorrow we do have a more detailed presentation in regards to the opportunity here at American Classic Agency. So if you need that information, how to log in, like Barb said, you can reach out to us and we'll be happy to get that over to you. We do have one comment from Miss Pamela. It says that life-changing message that everyone needs to hear. Very proud. So with that, I'm gonna go ahead and close out the night. Thank you so much again for being here, and we will talk to you all soon. Bye from Sharia and Barb and Kim and Monique and Crystal. We'll talk to you soon. Bye.